Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Thanks for joining us on The Bigger Picture with me, Ryan Huang. And we are looking at the current market environment possibly becoming an opportunity for investors to diversify their portfolios across regions and asset classes, as well as to reduce concentrations in their portfolios. And this with the overhang concerns of tariffs and trade tensions, and this growing interest by some pockets of investors to look beyond the US for better value and risk reward. So where should we be looking at more closely these days? Let's check in out Mel Siew. He is the portfolio manager for Asia Public Credit at Muzinich Co. Mel, good morning. How are you doing today?
Morning. I'm doing great. Thanks.
Yeah, great to have you on. So you've got a lot going on in the backdrop of markets. You've got the tariffs, you've got the trade tensions, and also this trend of fund managers starting to move away from U.S. assets. How much are you seeing in your part of the world? How prevalent is it?
Sure. So I do think that this is one of the trends that is being talked about quite a lot. Where we see it most actually is in European investors who had been very much overweight U.S. assets. We've seen some pullback there, but we haven't really seen a major pullback elsewhere. Now, going forward, I think if you have an incremental dollar to invest, you would probably choose to invest it away from the US. So that's where I think the flows will go. But in terms of people selling down their existing stocks, we're not seeing that. And I'll give a couple examples. So the Hong Kong government issued a dollar bond, a US dollar bond, and a euro bond as well. And for the first time, we actually saw the order books for the euro bond being much bigger than for the dollar bond. And that has done very, very well. And then we also saw AIA did a Singapore dollar bond. And then that also had tremendous international interest. Normally, you'd get very strong interest from Singapore investors and not so much from international investors. So at the margins, you can see how demand is and interest is growing.
Yeah. How much momentum is there behind this move? Do you see this as just a temporary thing that's happening this year and then things would normalize back to U.S. assets next year?
I mean, I think over the past couple of years, the US had been the place everyone had wanted to get exposure to, and it has done very, very well, right? The performance has been unquestioned. So I think now with all the uncertainties in the world and the market, some rebalancing is due, right? And maybe some profit taking as well. But in terms of a longer term trend, it's very hard to see past the US dollar and the US because it's time and time again proven to be very robust.
On your side of the equation, how have you been positioned and how have you managed or adjusted in the past year?
Sure. I mean, I think front and center in everyone's minds had been, Liberation Day. And that was a clear, for the markets, risk event. And we had de-risked ahead of that. But then what you saw was with the pullback in the tariffs, the pauses, the markets recovered very, very quickly. And with some of these pauses as well, you've taken away the more extreme scenarios, especially with the US-China tariff pauses, right, in terms of US recession risk. So I think the consensus forecast now is for a slowdown in economies, and with yields very, very high in credit still, historically high yields in bonds, and fears over uncertainty and volatility. If you stay short-dated, you are able to generate a very, very healthy income, certainly higher than what you have in previous years in fixed income in bonds.
Yeah, what is the market telling you when it comes to the pricing of sales? Are they looking at a slowdown of sorts in the global economy? How much of a slowdown are we looking at?
So I think if you look at sort of recession scenarios, you can think of the big ones recently have been, a COVID slowdown or GFC slowdown. I think we're not pricing in, we're not looking at those types of slowdowns, but just a growth slowdown. So economies should still continue to grow. In this region of the world, central banks have room to cut rates. A large number of them have signaled that they will be doing that. What has prevented them doing that in the recent past has been the currencies, concerns over the currencies. With the US dollar weaker, that has provided a bit more room for them to cut rates. So that will provide some offset to tariff headwinds.
Yeah, that's a great point. The US dollar is getting weaker. Where do you see this going? And where do you see this in terms of the diversification away from US assets? We are seeing more Asian banks starting to reinvest in their own assets, in a sense, not going back into US assets.
Yes, so I think there is a bit of rebalance. How long does it go on for? I think that's a difficult question to answer, but it's definitely at the margins, I think, a trend that we see.
And you see Asian credit as a safe haven right now with all the uncertainties. What are you seeing in terms of the flow right now? Where are they going in terms of Asian credit?
So the big market that has attracted lots of attention because of the growth potential has been India, has been a big market. Southeast Asia as well. So those are the two big pillars. But a lot of interest recently in China again, because after a long period where the economy has come under stress, you can see some green shoots. They had lots of announcements earlier this year regarding AI, and the Hong Kong stock market seems to be back this year as well. So there's lots to be positive about in this region, not just from central banks and policymakers, but also from the robust economies, that should be pretty resilient despite being in the eye of the storm of tariffs. And as I said, being a safe haven, relatively speaking, when we look at everything else that's going on in the world.
Yeah, the Chinese story is interesting because there are still some concerns structurally about how things are not really for China out of the woods in that sense. The unemployment picture for the youth side of the picture. You also have the property situation as well. So how much are you seeing in terms of a turnaround in China when you look at the data, the growth story there?
I think there's always a bit of impatience that the policymakers could go faster, but they take perhaps a longer term view than people would like. So at the margins, I think they have drawn a line under where they see the economy heading towards, and whenever it gets close to that floor, then you see them reacting. And so we have felt very confident about this for the past year and a half, that they will do whatever is needed to ensure that the economy stays on track.
All right. And of course, we've just come off the back of the latest FOMC rate decision. No changes as what you expected. What does the latest meeting inform you about where things are going?
So there's a huge amount of uncertainty that came across several times in Powell's prepared comments and in the Q&A afterwards. Policy is, I think, at the right sort of place now. The U.S. economy is still pretty robust, 4.2% unemployment. Some, you can see services inflation coming down. And the concern is, what is the extent of the goods inflation to come from tariffs? Haven't seen that yet. And what is the extent and duration of that? So they've given themselves a summer. Effectively, they signaled that. But they've kept 2 cuts still for the rest of the year. So that's how we would expect that to play out. And if there's any changes to the data that surprise the downside, if the labor market gets even weaker, say, they could react, right? That they've left themselves that option.
Yep. So looking at the data to inform the next move. And we've been in conversation with Mel Siew. He's the portfolio manager for Asia Public Credit at Muzinich Co, talking to us about the latest FOMC rate meeting as well as where things are in the fixed income world. Thanks for your time, Mel. Great chatting with you.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.